soaring silver, if it continues, could well, if you like, raise questions about counterparty risk in derivatives markets. And this is particularly the case for London, which is an OTC market. And I think on that basis, if you've got a counterparty risk problem developing in derivative markets, then that's going to spread not just from silver, but into gold, into other commodity contracts. And because all the operators in those markets, those derivative markets, deal in everything else, whether it's interest rate swaps, whether it's currency swaps, whatever, all those things, then they're going to be questioned. I mean, we're, if you like, rather on the edge of a precipice, looking down into a chasm. That's where we are. And people who don't understand this are going to get caught, I mean, very, very seriously. When the bubble pops, you'll find that banks have stock as collateral. They will sell those stocks in order to secure the value of their loans against them. So you're going to get a massive selling from the system, which so far has been pumping in funds into stocks. And at the same time, foreigners will try and run a mile. I mean, they've got over 20 trillion invested in US equities at the moment. And when they see the market begin to crash, they will go. And so that's a big source of selling. I think they'll probably only get out with less than 10 trillion, personally. I think they'll probably only get out with 5 trillion. They're going to lose a lot of money. And they understand this. As soon as the bubble pops, they're out. They're going to try and get out, and that's going to crash the market. So I see this happening in the not too distant future, and anyone who is invested in equities better watch out. I mean, we could see 90% of the S&P, NASDAQ, whatever, being wiped out. It wouldn't surprise me at all. If you actually understand what gold is telling you, it's actually telling you that next year is going to be awful for financial assets and the economic outlook. Particularly the Fed has given up on trying to control inflation. The official story is inflation is no longer a real problem. Okay, it's 50% above the desired level, but we're not worried about it. Therefore, we end quantitative tightening, and to ensure there's ample liquidity in the system, we're going to start quantitative easing.
Alasdair Macleod delivers a chilling forecast for 2026. The popping of the massive stock market bubble that will trigger a catastrophic financial collapse. As the Federal Reserve panics with renewed quantitative easing, banks holding $20+ trillion in equities as collateral will be forced into massive sell-offs, while foreign investors flee. This coincides with a commodity supercycle as China restricts key resources like silver and rare earths, driving raw material prices 5 times higher in dollar terms.
Commodities are cheaper than they've probably ever been priced in gold. Now, a lot of that is because gold is front-running the collapse of the dollar. But what it means is that in 2026, you're going to see commodity prices rising back towards where they should be compared with gold. And I reckon base metals are valued at under 20% of where they should be currently against gold, which implies that to get back to where they should be, they're going to go up 5 times. I think there is ample liquidity in the system. The problem is that banks are getting worried about extending credit. And so that's the real issue. And the idea of reducing interest rates and doing QT and therefore flooding the bank's balance sheets with the most liquid form of deposits possible, i.e. reserves at the Fed, is not going to be the solution. The only debt that's really selling is very short-term debt, which actually tells us that global investors see the Fed sliding into a debt trap. I mean, what's the right rate for a 10-year bond or a 30-year bond? I mean, I know what the market's saying, but the market is, if you like, in a sort of stasis on this. But if the Treasury really tried to test it, I think you'd find that yields would start going up quite dramatically. The real problem which we now face is that as these bond yields at the long end begin rising again, that'll undermine the equity bubble. And we're already seeing the equity markets looking tired, let's put it that way. China, I think, to take some very serious decisions to protect its own resources. Its own resources being, we've got, silver. That she stopped supplying silver automatically to the rest of the world, which was what was depressing prices of that. There is absolutely no doubt. So silver has taken off. And I think there's a growing realization that it's not just silver, but China is actually a major source, global source of processed rare earths, antimony, cobalt, all these things which are needed now. So the entire base metals sector or basket of them has actually moved up because China understands that this is happening and has understood it for a long, long time, which is why they have been buying gold, which more correctly put means, which is why they have been selling dollars and also selling euros. They've basically they have a policy of reducing their exposure to G7 currencies as much as they practicably can. I have absolutely no doubt that for trade settlement purposes between BRICS members and Shanghai Cooperation members and China, whatever, and Russia, she plans for the yuan to replace the dollar in a new sort of Bretton Woods version 2. As I said earlier, China's worked out a long time ago what the end game was. And I think they understood that America's power is entirely tied to the dollar. They haven't actually done anything to destroy the dollar. Why do that when the Americans are destroying the dollar themselves?
The result will be hyperinflation the Fed can't control as the dollar's purchasing power collapses. Meanwhile, China prepares to launch a gold-backed yuan through BRICS, leaving the U.S. with no political will to implement fiscal discipline. The only protection is converting credit-based wealth into physical gold and commodities before the system implodes. Subscribe to Fine Metals for future updates.
So we're beginning to see inflation, which so far is not being discussed at all in monetary circles. And I think that is interesting, and I think it's irresponsible, actually, to just sit on that story. There is a big change, and it is going to be very, very inflationary. I think that's the key point to understand. Inflationary in the sense that, and I always prefer to look at it this way, inflationary in the sense that what will happen is that the dollar's purchasing power will decline a lot more than people think in 2026. I think the big surprise for everybody will be the degree of inflation, which is the consequence of the collapsing value for the dollar. You then ask yourself, what does the Fed do about it? It can't do anything. It's actually trapped. That we're seeing the end of the fiat currency system. That's really what it amounts to. Something I can't see at the moment. Unless there's a change in that, I'm afraid the dollar and the euro are going to zero, and sterling for that matter. Zero. So if people who want a forecast for the gold price, you won't get a forecast from me. But what I will tell you is that forecasts are completely irrelevant, and the collapse in the currencies will drive the exchange rate between those currencies and gold. So that gold way up there somewhere in the heavens. And I think that'll become a lot more obvious to a few of us in 2026. As far as the wider public is concerned, if the dollar survives into 2027, they will finally realize that it's not prices going up, but the dollar going down. And therefore, they will start dumping the dollar. They will start dumping any liquidity they've got in return for goods, whether they need them or not. Flight into real goods, if you like, is the death throw for any fiat currency. And I think sometime in 26, maybe into 27, that's basically where we're going. I'm not sure they are aware of the issues. I mean, bear in mind that the entire establishment, not only in America but also in the UK and Europe and also in Japan, are sort of Keynesian-based macroeconomists. They don't understand money. They don't understand credit, and that actually is number one when it comes to dealing with a crisis of loss of purchasing power of a fiat currency. And I mean, history shows that even those who do understand it, and we don't really have them in the system here at all. I mean, that there may be a few, but they're not in a position of power. History shows that even if the powers that be do understand what is happening to the purchasing power of a currency, of their currency, politically, they're powerless to do anything about it. This was the lesson from Germany in 1920 to 1923, when Karl Helfferich, I think that was his name, who was the finance minister. I mean, he actually understood what was happening, but nonetheless, he presided over the collapse of the Reichsmark. He was also the person who engineered the recovery out of the destruction of the Reichsmark, which is something which not many people know. So why did he permit it to happen? Well, the answer is that he had no political alternative. The Fed basically going into overdrive, issuing currency, issuing bank deposits through QE, trying to save the whole system. The collapse could actually be quite rapid once it starts. Any wealth tied up in credit is at risk, and severe risk of going down to zero. So you need to understand what the difference is between money and credit. And in law, common law, not American jumped up legislation, but in common law around the world, money is only gold, possibly silver, but principally gold, because that is what the central banks have protected themselves with. They don't buy silver for very good reasons. It's an industrial metal, and it's being priced as an industrial metal. It's really gold. I think there are investment alternatives, as it were, but they'll all be in the commodity space, not in AI, not in whatever. I mean, there's going to be, that's the potential for a crash. I mean, where else does JP Morgan go is the answer. They've also, I don't know how far it's got, but they're also changing the rules, for the amount of capital that large banks hold. Now, if they invest in UST bonds, then the argument goes that that is the most superior form of asset on a bank's balance sheet, and therefore it doesn't need to have the extra capital required under Basel III for very large banks with international business. So, I mean, the US Treasury is trying to create a situation whereby it can continue to fund itself. And this is, it all amounts, I think, to desperation. Absolutely. And of course, the other thing, Anthony, if I can sort of just take that a little bit further, is you have to ask yourself why it is that these banks are not prepared to extend credit to, the private sector, the real economy. I mean, the governorship of the EU is failing completely. I mean, it's a complete failure. In the UK, we've got a government that's got absolutely clueless. It's pursuing, classroom socialism. I mean, these guys know nothing at all, and they're just destroying the economy. We do have, very bad problems in Europe, and that's something which, basically the whole system will fall over when America falls over. I think that's the key to understanding it, because those in power in Europe, and the other thing is that, in terms of geopolitics, they've completely lost the plot. They almost need to cast Russia as evil in order to protect their own positions, which is bad. It's very, very bad. And the intelligence services are pandering to their political masters, telling them what they want to know. Yeah, the Russians are evil, etc., etc. They're doing this, they're doing that. We've got to defend ourselves, and we've got to go and defend Ukraine. I mean, Europe is a mess. Europe is basically bust. And she's got a plan to protect herself. Now, she won't, I think, anticipate events in the sense that announce a gold standard tomorrow. She will only do so when it is absolutely clear to the world that she needs to put it on a gold standard, the yuan onto a gold standard, in order to protect herself from a collapsing dollar. And I think that's something we're going to see maybe in the second half of 2026. And that's going to make the situation even worse for the dollar. And you've got to ask yourself, how do the Americans respond to that? Well, under the current, in fact, I mean, it doesn't matter who the president is. They are not prepared to go back onto a gold standard, to make the cuts in public spending, public sector spending, necessary to balance the budgets and produce a surplus, and to withdraw from interfering in the underlying economy.